Hello everyone, this is Ekta Shaw from PIBM FA1. Today I will discuss about the topic why commercialization became necessary in rural and microfinance. So today we are going to understand an important shift that happened in rural finance. The movement from charity-based microcredit to commercially sustainable microfinance. When microfinance first started, the goal was very simple, that was give small loans to poor household who were ignored by banks. These borrowers did not have collateral, salary slips, or credit history. Traditional banking system considered them risky, so they remained outside the formal financial system. In the early years, lending was driven mainly by social motives, institutional focused on helping people rather than earning profit. But over the time, it became clear that goodwill alone could not sustain financial services for millions of rural households. Gradually, microfinance institutions began adopting commercial principles. So the key question here arises, why did commercialization become very necessary for the microfinance? So we will answer this question one by one. So understanding the limits of charity-based lending. Initially, many rural credit programs were supported by government, NGOs, or donor agencies. Interest rates were kept artificially low, sometimes even zero. The idea was that cheap loans would reduce poverty. However, three major problems emerged in this case. First, funds were limited. Donation and subsidies could support only a small number of borrowers. But demand for credit in rural areas was enormous. Farmers needed seasonal loans, women required working capital for small businesses, and households needed emergency funds. Secondly, repayment discipline weakened when borrowers believed loans were government assistance rather than financial obligations. Repayment rates fell. This created a cycle where institutions constantly needed fresh funding to cover losses. The third, operations were expensive. Serving rural customers required field visits, group meetings, training sessions, and monitoring. The cost of delivering a 10,000 rupees loan in a village could be almost the same as delivering a rupees 5 lakh loan in a city bank branch. So, as a result, many programs collapsed after donor funding stopped. This was the first realization a financial service that cannot recover its own cannot survive. Its own cost cannot survive in this program. Another topic is growing demand and financial inclusion. By the 1990s and early 2000s, policymakers understood that poverty was not caused only by lack of subsidies. It was caused by lack of access to reliable financial services. People did not just need cheap loans, they needed continuous access to credit, savings, and insurance. Let us imagine a rural shop owner. He needs a working capital every month, not just one. He the If the institution shuts down because of funding shortage, he goes back to the money lenders. So the objective here is changed. Early goal was give loan to the poor, but the new goal here is build permanent financial institution for the poor. And the permanent institution requires stable funding, professional management, and financial discipline. This is where commercialization entered in the picture. The commercialization did not mean abandoning social goals, but it meant that making the system strong enough to serve people for decades instead of few years. Now we are moving forward to the another topic, that is cost of serving the poor. One of the biggest misconception was that lending to poor people should always be cheap. In reality, small loans are expensive to deliver. consider two scenario here. A bank gives rupees 10 crore loan to a corporation handled by one officer. A microfinance institution give 10,000 rupees loan to 1,000 borrowers. Require many field workers, travel and monitoring. Plus, administrative cost per rupee is a far higher in microfinance. Therefore, if interest rate remain extremely low, institution incur losses even if every borrower repays. Loss-making institution cannot expand outreach. Commercialization allowed microfinance institution to change reasonable interest rate that covered operational cost, risk cost, inflation, and growth capital. Once costs were covered, the institution could open more branches and serve more villages. So, commercialization actually increased outreach instead of restricting it. So, the next topic is access to capital through commercial models. So, another major challenge was here is funding. Donor money and government grants are unpredictable. Some years funds are available, some years they are not. But borrower need credit regularly. So, commercialization allowed microfinance institution to access bank loans, equity investment, capital markets. Investors provide funds only when institutions demonstrate sustainably require profitability, transparency, and government standard. When microfinance became commercially viable, the scale expanded dramatically. Institutions could reach millions instead of thousands. In simple terms, subsidy model equals to small impact, short life, but commercial model equals to large impact, long life. Here's the sustainable model represents improved discipline and accountability. So, commercialization also changed borrower behavior. When loans were seen as welfare schemes, repayment was treated casually, but when institutions operated professionally, borrowers understood that credit access dependent on repayment discipline is not just enough. So, this improved the credit culture in rural areas. At the same time, commercialization improved institutional accountability. Investors and regulators demand audits, transparency, and responsible lending practices. This reduces the leakage and corruption common in early subsidy programs. So, commercialization strengthens both sides of the transaction, lender discipline and borrower discipline as well. So now we came to the conclusion that is a concern often raised is whether commercialization harms the poor. The reality is that sustainability, a social impact are not opposite. A financial stable institution can serve poor continuously. An unstable institution helps them only temporarily. The real change is balance. Microfinance institution must remain profitable enough to survive, but responsibly enough to avoid overlending. This balance is known as the double bottom line, financially sustainable and socially outreach. So, commercialization became necessary because charity based rural lending could not scale, could not survive, and could not provide continuous access to financial services. But by adopting commercial principle, microfinance transformed from a short term poverty to a program into a long term financial infrastructure for undeserved communities. In simple words, commercialization did not replace the mission, it protected the mission. Thank you very much. Thank you so much.